All right. Good evening, everyone.
Good evening.
Hi.
Thanks for braving the weather tonight. So tonight's session, welcome to session number 2 of Financially Fit February, Building a Strong Foundation.
Wait, should we scooch in? Yeah.
Sure, you can scooch in, scooch up,
So then you don't have to keep going.
scooch whatever you like.
Scooch is such a good word. Maybe a little easier.
Sure.
Scooch all over your side. Well, we have the heat.
That never works for me on Sundays. I can't just scooch people up close.
Do
They
you-
never listen to me.
Do you try?
No, I don't know if they listen. She wouldn't listen to me.
Maybe if you put Deb in charge of the scooching. I think she could be the scooching director.
Scooching ministry.
No,
Yeah.
pastor said one time they put in new church pews and they wanted to make them automated, but they hit a button and it was all.
That'd be funny.
We told the congregation we were doing that. You know what their suggestion was? There need to be something under the pulpit to drop pastors.
That's true. One of those hooks that comes out of the wall. So,
So
all
it
right.
worked both ways.
Okay. All right, so as I mentioned, our topic today, building a strong foundation. I've got a handout that I'll pass out here in a little bit. And I've got quite a bit of information here. And my guess is that for each of you, and maybe if people watch us online, you know, maybe half of what I talk about will be helpful to you and half won't be, and it'll be something different for everybody. So, so anyway, as we're going through this, it's going to be fairly dense, and I'll try to move fairly quickly so we're not here all night, of course. But please interrupt anytime and ask questions. So actually, maybe before I get started, I'm supposed to do this, introduce yourself. So for those of you who don't know me, Tom Howard, attend the 11 o'clock session here regularly. And see if our clicker works. Maybe.
What are you doing up there?
There we go. And I look for any excuse that I can to put up a picture of my kids on the board here. So that was Emily's birthday a little over a year ago, and breakfast pancake. I had birthday pancakes for breakfast. Anyway, so back to business here. So our first session was self-evaluation and goal setting. Was everybody here? I think you were all here last time for that? Okay. So who took some action after last week's session? Linda took some action. You're at least the only one that was brave enough to raise your hand. Would you can say no, but would you want to share what you accomplished this past week?
Well, when you said, don't put off some of the things that you think you should be doing,
Yeah.
I tackled that because there were a couple things I should be doing, and I just kept putting them off because they weren't easy to do,
Yeah.
but I did.
Super. All right. Good job. Good job. So, so I would of course encourage everybody to do that, and take care of what you need to do. All this information. Hopefully there'll be some helpful information, but it really doesn't do a whole lot of good if we hear it one day, don't do anything about it. They say that you forget everything that you've heard within 3 days or something like that. So, all right, you get a gold star. So for tonight's session, there are, I think, 2 possible outcomes. So number one is you could take some action and improve your financial foundation in one of the ways that we talk about. And or you could share this information with someone else. So as we're going through this, I have to think that there will be at least one thing that somebody would benefit from learning about. So just like other things that Steve asked you to do, I'm going to ask you to go out and share this information for the good of your friends and family. And to go along with that, I've got a verse here from Proverbs. Teach your children in the right way, and when old, they will not stray. the rich rules over the poor, and the borrower is a slave to the lender, right? So pretty good verse there. It could be just about helping people, and it doesn't have to be necessarily about money. Now, also last time, I showed this little box here about urgent versus important topics. So does anybody remember where, at least what I said, was the best place to spend as much time as you could? The top right, exactly. Important but not urgent, right? And I think as we're going through this, probably everything that we talk about today would probably fit into that category, or the vast majority of it would fit into that category of things that are important but probably don't feel urgent. So, next question of the pop quiz. I outlined this briefly last time, and I'll hand out, maybe I should hand out the papers here. So what are the different sections of our financial house? Anybody remember what goes on the bottom? Remember the roof. What was the roof, Steve?
Yeah, the roof was
sorry.
legacy, right?
Roof was legacy. No, pass it back, thanks. All the answers are on page 2. Don't skip ahead.
Foundation, that makes sense.
Foundation was on the bottom. Legacy, exactly, was here at the top. What are the parts of our foundation?
Income or assets?
So income is sort of related, is part of cash flow, is the first thing. Any other guesses?
Investments is one, isn't it?
So accumulation is sort of the second floor part right there. Our other things are emergency savings, protection, and legal documents. And they don't have to be in this specific order, but cash flow, emergency savings is the second box of the foundation, protection, and then legal documents. Then we have the accumulation stage. Then we have the distribution stage, right? So we save so that we can use that in the future and hopefully leave a legacy. But the whole concept of the foundation is that these 4 parts here are really meant to be the foundation. And when something bad happens, you have these safety nets in place so that a speed bump doesn't turn into a major catastrophe, for example. So, also last time I handed out, this was part of the packet, this little self-evaluation form. If anybody doesn't have that or need another copy, let me know. I brought some more copies today. But moving on to today's, again, here's our house. If you missed any of the answers on the parts of the house. And to go along with that, I've got a section here from Matthew talking about building a house on solid rock versus on sand. Now, of course, this is not meant to be used exactly the way that I'm talking about it right now, right? It's used as a metaphor for faith. But again, the same thing happens, is we want to have a solid foundation built on not rock, not built on sand. That really applies to lots of different parts in life. So anyway, first thing, we can go to the second page of the packet. So cash flow, what do we mean by cash flow? Real simple concept there is you have some income, and then you have some expenses, then you have some spending, and I'm calling those expenses probably the requirements, the musts, the needs, and then in this case I'm calling spending more of voluntary things. And at the end of the day, then you have net cash flow. And that number could be a positive number or a negative number, right? If that number is consistently a negative number month after month, then there's really not much progress we can do on other parts, right? Now, in terms of then the second box, savings. So on the lower section here, emergency savings recommendations. Oh, excuse me, I'm skipping. I gotta watch where I'm at here. You don't need to look at it right now, but in the back of the packet, I've got a little worksheet here that is a pretty basic expense budget. And I've got it broken out into 3 different categories: musts, probablys, and then luxuries. Now you can make an argument that some of these things maybe should be in different categories here. And of course, not everything on this list will apply to every person, but there's a list of things that are musts for most folks that you should have an idea of what those average, and then of course have an idea of what your probablys and what your luxuries add up to. I once heard somebody say that having a budget like this is having a plan to tell your money where to go instead of wondering where it went, right? So if you haven't done this before, I would highly recommend first just going through here fairly quickly and taking your best guess at what all these things are on a monthly basis. And then to really do a thorough job, go back and see what your actuals are, right? But so anyway, that's the cash flow piece. Pretty simple there. Now, anyway, back. Sorry, I'm skipping around here, but back on page 2. So once you have an idea of your cash flow, then you can have an idea about what might be appropriate in terms of emergency savings, the second box. Now, like other things in this packet, these are not absolutes. These are sort of rule of thumbs, and everybody's situation is going to be a little bit different. But in terms of how much emergency savings you should have, which might be, for example, a savings account in the bank. If you are someone who's working, who's in other words, in the accumulation stage of their financial life, then a good rule of thumb would be 3 to 6 months worth of expenses is for how much to have on hand for emergencies. And if you at a minimum, if you go through that first column of musts on the other sheet, then multiply that by 3 to 6, and that's the general recommendation for how much you might want to have in like an emergency savings account in the bank. Now, if you're in the distribution stage, in other words, you're retired, then it's a big it depends. But kind of a starting point is taking a look at what we'd call 1 to 3 years worth of withdrawals. Now, here's what I mean by that. So, for folks who are retired, you may have some guaranteed income, Social Security, pension, for example. If you are withdrawing from other places like an IRA, right, on a regular basis to meet your needs, then you want to have an amount in cash in the bank that's probably equal to between 1 and 3 years worth of those withdrawals, if that makes sense. So if you withdraw $10,000 a year over the course of a year generally just to meet your needs, and you're doing that from an IRA, then between 10 and 30,000 would be a logical number to potentially have just liquid in the bank. And then other savings would probably make sense to have in places where you can earn a little bit more growth on them. But so that's our rule of thumb, to have that as a safety net. So I hope that makes sense. I'll pause for a second. Questions so far? All right, we'll keep moving. So our next stage is protection. So Protection in financial terms, what we're referring to there are really different kinds of insurances. So it starts with the pretty obvious stuff at the top. So homeowners insurance, probably everyone who owns the home, especially if they have a mortgage, are going to have homeowners insurance. Next is renters insurance. I meant to look this up, but I didn't. What percentage of people that are renting their home do you think have renters insurance?
5 to 10.
It's probably a pretty low percentage, right? What happens if there's a fire? What happens if there's a burglary or a pipe bursts or whatever, right? That's going to be some significant hardship there. So, don't quote me on this, but I would think that for a lot of people, maybe, $20 a month of renter's insurance is probably a pretty wise expense to take on for people who are renting. Auto insurance, I think that everybody probably understands that. And then we have umbrella insurance. So umbrella insurance usually comes in blocks of $1 million. And it's something that you get from a property and casualty insurance agent, like where you have homeowners or renters and auto policies. And it's basically to cover things that are above and beyond what you might need from your homeowners and renters situation. So for example, if you're in a car accident and you get sued, there's $1 million right here that would be used for that, right? Now, $1 million of umbrella insurance coverage usually is going to cost somewhere in the ballpark of about $15, $20 a month. Again, probably a pretty wise thing to have, if you ask me, to protect you and to protect your family there.
And those are sold by Lewis and Company, is that sell you auto insurance?
Exactly. Yeah. Yep. So if you any of the you could probably name at least 5, 10 or more big homeowners and auto insurance companies. That's where we have our umbrella coverage through the same company that we have our homeowners and auto through. If anybody wants a recommendation, I'm happy to make an introduction for you too. Very nice lady right here in town. So then next, health insurance. Pretty simple, straightforward there. And then next we've got something that gets kind of complicated. We'll get to that in a little bit here. Long-term care insurance. And then finally, I've got disability and life insurance listed. So long-term care insurance is, what's the purpose of long-term care insurance? It's for certainly something like a nursing home or it could be even for assisted living. Can often be used for in-home care, right? And in order to, if you have long-term care insurance, in order to have a claim and benefit from it, it usually goes by what's called activities of daily living, ADLs. So things like being able to stand up, dress yourself, use the bathroom, bathe, things like that. So if people need assistance with those type of things, whether it's in-home or in a facility, that's where long-term care insurance comes from. Not to be confused with disability insurance. We'll get to that in a minute. So long-term care insurance, I realize now that y'all probably can't read this at all, but this is from the Medicare website. And some people are under the impression that Medicare will pay for long-term care expenses, like I just explained. And it says right here on the Medicare website, Medicare does not cover long-term care, also called custodial care, if that's the only care you need. Most nursing home care is custodial care. You pay 100% for non-covered services, including most long-term care from Medicare, okay? Not uncommon for people that need in-home care that can, depending on the level of it and the amount, could be $2,000 to $4,000 a month. Fully skilled nursing home in Pennsylvania can be $10,000 a month, right? So, that kind of expense is going to have a significant effect on almost everyone. There is some limited Medicare benefit for a short period of time, but it's pretty limited. There's some conditions usually for the first 100 days that you might need care. So anyway, That's where long-term care insurance comes in. Yes, sir.
Could you give me an idea of how that works? We talk about having 10 grand in like monthly bills.
Yeah.
Ballpark for me, like if you're someone that's you know in the particularly the age maybe where you're looking at that in the
Mhm.
coming future, what would be the price you would think, and what would that pay for? How would that reduce that price?
Yep. As usual, you're 2 steps ahead of me.
Oh, sorry. Yeah, there, go ahead. Sorry.
That's all right.
That's-
So there are 2 types of long-term care insurance. So the first one is what we'd call traditional coverage, and that works the way that you usually think about insurance, where you have a premium that you pay monthly or you pay annually, and then if you need care, then the insurance will cover it. Now, generally, when people are looking at long-term care, they ideally, if it's on their mind, they start looking at it maybe when they're in their 50s. Occasionally somebody younger than that will start to look at it. 50s or 60s. It's not impossible, but once you get above, say, age 75, it gets harder and harder to qualify for it because there's a whole underwriting process. The insurance company wants to check you out to see what the odds are that they're going to have to, pay a claim for you. So anyway, and then once you get, as you get older, then also the premiums are going to rise for the same amount of coverage, right? If you start at a young age, the insurance company thinks they have more time to collect money and save it up to eventually pay a claim for you. So anyway, the traditional long-term care insurance, most people would say that it is not inexpensive. Let's put it that way. So what is the downside of that, of having that coverage?
You pay a lot of money and then just keel over dead one.
If you never use it, exactly. So if you never use it, then you had protection, but similar to you could have auto insurance all your life, and hopefully you're not going to need as much coverage as what you had paid for. But same thing. So today, hybrid plans are a lot more popular than traditional plans. And here's how the hybrid plans work. You'll pay a premium either in a lump sum or over the course of 5 or 10 years typically. Then there will be a life insurance death benefit that's larger than the premium amount that you pay in. And then there will be a long-term care benefit, which is larger than those. Okay? Now, to give you an example, and don't hold me to this, but just kind of a ballpark here. For someone who is maybe in their 50s and in pretty good health, if they end up contributing $50,000 in premium to a policy like this, they, for that, might have a death benefit of $150,000 and a long-term care benefit of $250,000. Again, don't hold me to that, but the math will work out something like that. As you get older, then those numbers get closer together. As you're younger, those numbers are spread farther apart, right? So people like these plans because it's a guarantee that one way or another, the family's going to benefit from a plan like this. And these plans will also very often have a return of premium feature, where if you want your money back, your $50,000 or some component of it, you can have it back, no questions asked, and you'll either then just if you take the whole amount, then it just cancels the policy, or if you take half of it, then the other benefits will basically be cut in half as well. So really there's nothing to lose in these kinds of plans, but they're going to be larger amounts in larger chunks. So
Die, can your family get the original amount?
exactly. So yeah. So if you pass away without ever needing the long-term care, then there's a death benefit for your family. Exactly. Yeah. Yeah. So you can see why those are more popular than the standard kind of plans today. Other questions about that?
So in some ways that really falls more under almost the legacy section of making sure that all these things that you build up for your life aren't just sucked back into the...
So that's a part of it, right? So you think about this, and you have, regardless of the stage of life you're in, having some foundational elements is important. And if somebody does a great job of accumulating and saving for their whole life to be able to enjoy retirement, and then they end up in a facility or something else happens, and that's going to erode that very quickly. So yeah, basically here, something like this could be to preserve a legacy, for example. That's absolutely right, Steve. Yeah, exactly. Okay, so now long-term care insurance is different than disability insurance. So disability insurance, I would sometimes call paycheck insurance, right? So if you are disabled due to illness or injury, and you can't work, and you have disability insurance, then you'll still continue to get a paycheck coming in. Now, typically the benefit on disability insurance policies most often is around 60% of your income. Okay, so if somebody has $100,000 income, they become disabled, their disability pays, then they'll probably have $60,000 a year coming in, or if they make $50,000, then $30,000 would be the income they have from disability insurance. One policy is not going to replace your whole income, but certainly can help out quite a bit. Now, two different types there. There's the most common thing people have is group disability insurance, so through an employer. But there also are individual policies that you can go out and get on your own, and people can have both of those. So very often, doctors, for example, will have both, so that they have close to 100% of their income replaced should they become injured. And a surgeon could have a hand injury that would prevent them from doing surgery, and so then disability insurance would be very important to them. Now, with disability insurance, important to also know that generally speaking, if you're getting it through a group arrangement like a workplace, the income from that is going to be taxable. So you have to kind of factor that in as you're planning for this. However, for individual policies, it's generally not taxable. That's not written in stone, but that's oftentimes the case. So when thinking about disability insurance, and people wondering, well, is that a good idea? Well, is it worth the cost? I like to put it like this: if you take somebody who's working, and for easy math, let's say that they make $50,000 a year, but they got fired today. But the good news is tomorrow they get 2 job offers that are identical in almost every way, and one of them is for another $50,000 salary. The other one is for a salary of $48,500, but if the person can't work because of injury or illness for a prolonged period of time, they'll continue to receive $30,000 in income until they meet Social Security age. So they can either have $50,000 or $48,500, but then a guarantee of $30,000. Now, which of those sounds like a better thing to do? Probably the second one, right? That's disability insurance, okay? So most often disability insurance, if you get it individually, will be about 3% of annual income. So that's why the numbers are what they are. And pay then about 60%, usually tax-free right there. So disability insurance, to me, a good thing to have. Questions about that? All right, so now we get into life insurance. There's a bunch of red text on here. Hopefully you can read it. If you haven't figured out yet the red text or the part of the stuff that's missing in the workbook. So life insurance gets complicated fast. There are a lot of variations of life insurance. Now in the chart here, there are 3 most common types: term, universal, and whole life. So we'll focus on term here first. So term life insurance works the way that most people think about insurance, and it's going to be for a period of time. It'll be for a certain term, and you'll have with it, you'll have the rate that you pay guaranteed for a certain period of time. That might be a year, that might be 10 years, that might be 20 years that the rate's guaranteed. It can be on an individual or group basis, which is usually going to be, through work, of course, or bought individually. Of the different options here, it's the lowest cost, and it also has no cash value, right? So the insurance company, looks at someone and says, well, this person is 35 years old. There's a good chance that they're not going to pass away in the next 10 or 20 years. So we're going to charge them a fairly low premium. And if they do pass away, then this benefit will be paid to their family. So term insurance is usually going to be for people like me, for example, that have, especially if there are children or dependents at home, that depend on someone's income. Then we have universal and whole life policies, and now it starts to get super complicated, and there are many, many, many different variations. But basically, universal and whole life policies are types of permanent policies that the people can have for their whole life, especially a whole life policy. They can be individual or survivor policies. So an individual policy is a policy on one person. When that person passes away, the benefit gets paid to the beneficiary. A survivor policy is on two people, generally a husband and wife. And when the second person passes away, that's when the benefit gets paid. That can be a very helpful tool, especially in estate planning situations. A survivor policy of some size can make some good sense. Universal I have here as medium cost. It will have some cash value, and it gets super complicated. The cash value is generally not going to be as stable as it is in whole life policies, and that's money that you can take out of the policy, while still living. So there's going to be some cash value, but it's generally not going to be as much as in whole life. And there are universal policies that have some long-term care features that go with them that can be very helpful. So compared to that, whole life policies do have the highest premiums of the three and the highest cost. They will have the most cash value, may have some long-term care features. And with whole life, there are not a whole lot of there are about 800 life insurance companies in the United States, actually. There are only a handful that, I don't know the exact number, that have what's technically a whole life policy. And when you ask folks about whole life policies, they'll usually say that there are only three companies to really look at. There are three big mutual life insurance companies that pay dividends on their whole life policies. I'm biased, but I think that this type of policy probably only makes sense if it's with one of the three major companies. So anyway, those dividends will grow the policy, both the benefit and the cash value, and it can really make a lot of sense in a number of different situations. So that's the quick life insurance overview. Questions about any of that? So
what are the three? Do you know them off the top of your head?
What's that?
What are the companies that you mentioned?
The three companies, I don't know if Dwayne should record this, but the three big mutual companies are New York Life, Northwestern Mutual, and Mass Mutual. Those are all outstanding companies. If you're going to have whole life, nearly everyone will recommend that you get it from one of those three companies. There's some other smaller mutual companies as well, but those are the equivalent of McDonald's, Burger King, and Wendy's or something. They're by far and away way bigger than everybody else that does that. That's a big, it depends. It depends on a lot of factors. So I'm going to talk about that in just a second. So actually, let's kind of go through that. So here's a scenario. This may not apply to most folks in here right now, but let's say that we've got a couple named Paul and Jennifer. They're 35 and they have 3 kids, 12, 8, and 4. They each earn $50,000 a year in salary, and they each take home $3,500 a month, so $7,000 total is their take home. Now, of that $7,000 of take home, $5,500 they use for needs and wants, kind of from the chart from earlier, and they save $1,500 a month. Okay, so that's the quick shot of their financial lives. Now the question is, if one of them were to pass away, can the family maintain the same lifestyle and savings as they had before? Answer is no, not even close, right? That's going to be if one of them passes away, that's going to be a huge financial problem on top of course, a real tragedy there. So how much life insurance should they have? Well, there's no right answer, but here's the way I generally walk somebody through it. 3 separate categories. Now this is for people that have dependents. So they want to have some amount for final expenses, generally between $10,000 and $20,000. They may want to have some emergency fund. I just penciled in $50,000 for that. Then the big one is income replacement. So if they're going to replace someone's income for 16 years until that youngest person is 20, for example, that's $3,500 a month times 12 times 16, $672,000 is, assuming they get no raises, is going to be the income that spouse would have had. Now, does that mean that they should absolutely have $742,000 of life insurance? No, it doesn't mean that, but to me, that's kind of a logical starting point for folks that are in this type of situation. Now, on average, how much life insurance do people think people have that are 35 years old and have 3 kids? Certainly a lot less than 700,000, right? So yeah, so maybe something from work, maybe their mortgage, which might be $100,000, $200,000, $300,000, but which is a large lump sum of money, but it's not going to sustain the family, at least at their same level as until the kids are out of the house. So anyway. So then people were thinking, okay, well, yeah, Tom, sure, 742. How much is that going to cost? Well, depends on someone's health, but for a 35-year-old male, that could be anywhere between $33 and $93 a month for that much life insurance coverage, locked in for 20 years, right? Depends on their health, and they have to qualify for it. But at a young age, term life insurance, most people would find very affordable, assuming they're in good health. Now, I don't have slides on this for someone who is in a different situation, like with no dependents in their house. But it'll probably make sense to have some coverage, and the question would be, well, if someone were to pass away, what would the financial impact be to the family, and how much of that do you want to insure? So 10, 20, 50, 100, 200,000, their income is gone. If their income is gone, how much will that affect? So it gets pretty complicated. But to me, it makes sense for probably almost everybody to have some coverage of some kind. So other life insurance questions? All right. So last block here are legal documents. So 3 legal documents that I would consider to be essential for folks. The first one is a will. I think everybody probably knows what a will does. For a lot of people, though, if their finances are not very complicated, a will doesn't necessarily matter a whole lot, but it depends. It's an important thing to have, but a lot of accounts you can have a beneficiary on and they can transfer when someone passes away. But other things you do need to have a will for, like real estate. And of course, if you have children, you want to name guardians for your children. If you pass away without a will, the reason why, really what does it do or why to have it is because it will create a lot more work for your family if you pass away without a will in most situations. The state of Pennsylvania does have a will for you if you pass away without one, and they're going to follow their rules in that situation. So if you don't like that, you should probably have your own will. The second one is power of attorney. What does a power of attorney do?
You're incapacitated, who makes decisions?
Exactly, yeah. Basically, if you're incapacitated, this is who can make decisions for you, if people, dementia or whatever, there's different situations that can trigger the power of attorney to take place. So there's many situations where if somebody doesn't have a power of attorney set up, that also can create enormous strain on the family who's trying to take care of them and manage affairs for them. So certainly recommend having a power of attorney document set up. And then the last one is an advance directive, otherwise known as a living will. So that, of course, is to give people directions on what you would want done, what kind of medical treatment in a situation where you can't, speak for yourself. Again, what does it do is it really helps your family. So generally speaking, if there are situations where, mom or dad doesn't have a power of attorney set up, doesn't have a living will set up, they're in a situation where they, can't take care of things on their own, that's going to be pretty stressful. And do you think it's more likely that's going to bring the family together or push them apart?
Push it apart.
It's going to generally push them apart, right? And so, because no one wants to make these decisions. Everyone's got their own opinion, and you don't want to do the wrong thing, and it's very stressful. So the reason why people should have these ultimately, I would say, is because it's really something for your family that will help them at a very, very stressful situation. Now, these legal documents. You can go online and, for probably in the neighborhood of maybe between $100 and $300, you can have these legal documents set up for you. So if nothing else, I recommend people do that. If you go see an attorney, they'll be able to, kind of walk you through and make sure you understand everything, make sure everything is set up the way that you would want it to be, and make sure all the, I's are dotted and T's are crossed and whatnot. And these three documents for most people are going to generally go between $500 and $1,000 of legal fees for somebody to set it up. So that's about the extent of my legal knowledge. But any questions about the documents? All right. So, two more verses here. So, wrapping up some of the concepts here tonight. Proverbs 21: the wise store up food and olive oil, fools gulp theirs down. Right? We want to have some savings in place. And then, not the most uplifting verse from James here. You do not even know what will happen tomorrow. What's your life? You're a mist that appears for a little while and then vanishes, right? So eventually, there's going to be situations where these things are certainly important. Now back to my concept from earlier. So the different things that we talked about. So having some savings, having insurance in place, having legal documents in place. Hopefully for nobody in this room right now, do those things feel urgent? When will they feel urgent?
It's too late.
When it's too late. They will feel urgent when it's too late. Okay? So when someone calls me and says, hey, I really need to get some life insurance really soon, they might not qualify for it, right? If you realize, oh my gosh, I'm in trouble because I have no savings, it's probably because it's too late. If there's a situation like those legal situations we were talking about, it's too late. It's going to create a lot more stress for everybody involved. So taking care of these types of things that are important but not urgent is really is take care of them before they become urgent, because when they're urgent, they're emergencies. And the whole idea here is with your foundation is to prevent emergencies. And then one more verse for Proverbs. Train children in the right way, and when old, they will not stray. The rich rules over the poor, and the borrower is slave to the lender. Now, some of these kind of things, money in general, is for a lot of people is really kind of a taboo subject, right? And along with other taboo subjects, probably a lot of times, parents might not have conversations with their children. But let me ask you this: when you were 20 or 30 or 40, if one of your parents would have said, "Hey, how you doing financially?" Right? Would that have been a helpful conversation? Probably, right? So. Now you might not listen, but at some point perhaps. I'm not asking you to go in and do a full audit like the IRS of your grown children's finances, but ask the question. And even if you don't really get into any details, they'll probably appreciate you for it, and some good can come out of it. So that's what I hope. People do, even though it makes them a little uncomfortable. It's I think for the good. Now what about when somebody has got absolutely none of this stuff going on, and everything is really not good? Well, these are 8 baby steps. And this is slightly modified. I borrowed the concept from Dave Ramsey. I don't know if anybody's familiar with Dave Ramsey in here, but he's a guru that has a very large Christian audience. And I modified this a little bit based on some of my opinions, but it's his basic premise. So someone who is at 0, which might be someone just starting out in life, or maybe somebody who's kind of starting over at later in life, but baby step number 1 to get their finances on track, save $1,000 in an emergency fund as fast as possible, right? And Ramsey says if that means you have to go out and sell your comic book collection, do it. If you need to trade in your car for a car with a lower car payment to save $1,000, do it. But save $1,000 as fast as possible. And it's probably a good idea to put that emergency fund at a bank that's not your regular bank. So it's a step further removed and it's truly for emergencies. And then he also, talks about the definition of an emergency. A deal on a plane ticket to Florida is not an emergency, right? For example, right? So emergency is something that I think you all can know what that means. So second baby step is have the protection places in place that you need. So we talked about a lot of protection pieces, and all those different insurances do have a cost to them, but when you stop and think about them, I think that they all make sense. Some things more so than others, depending on what stage you are in life. Next thing, pay off debt with interest rates that are over 6% based on today's interest rate environments. And then if you have multiple debts, for people that maybe have 2 or 3 or credit cards, for example, that are all over 6%, use the snowball method. And that means you write them down and then you focus on the one that has the smallest balance first. The reason for that is to try to knock that out, get a sense of accomplishment for accomplishing that, and then move on to the bigger one. So don't go with the bigger one first, because if you struggle to do it, you may lose steam. So start with the smallest one first, and then go to the next biggest one, Again, and my recommendation is for things with interest rates over 6%. Next, fully fund an emergency savings plan. So we talked about that earlier, whether that's 3 to 6 months for working people or 1 to 3 years of withdrawals for folks that are retired. Get that fully funded. Maybe also put that at a bank that's not your regular bank, so you're not tempted to use that for non-emergencies. Next thing is a big one. Work your way up to, I'm not going to start out at 20%, but work your way up to 20% of savings, to saving 20% of income for retirement and other goals. Again, that's for folks that are working and not retired. After you do that, then college funding, or you could mix, probably level 5 and step 5 and 6, but saving for college for children. Then next, probably pay off your home early and other debt that has low interest rates. Student loans perhaps might have low interest rates. But my suggestion is saving for retirement. We'll talk about investments next time, but historically you should be earning a lot more than 6% on long-term aggressive investments. So that's why I have that in there. But paying off your home early, then will be the next step, and then giving generously. So doesn't mean you got to wait till you do all these things before you need to put something in the offering plate on Sunday mornings here. But really giving generously once you've done the other things is my suggestion there. So a place where people might disagree is having the protection as step 2. But again, if you're somebody who's in a difficult circumstance and you have some bad luck on top of that, then having those insurances in place are going to be very, very helpful. So I wouldn't wait to put insurances in place until you feel like you have other things accomplished. That's my suggestion. Questions about the baby steps? All right. So that's basically it. Thanks for coming tonight. If I can help in any way, please reach out and let me know. I'm happy to try to dig in and provide helpful information on any of these topics or more that we covered. So I'll hang out for a bit. If anybody does have a question afterwards, you're welcome to come ask me, and I'll ask Steve to come up and have us close with prayer tonight.
Thanks, everyone. We talk a lot in church about taking steps in our faith, about doing something, about taking some kind of step. And so I would urge you, Tom's giving you some wonderful steps, all of us some wonderful steps. So try to take a step. So next week when he comes in, it's not just Linda. But what are the steps? There's something. I think each and every one of us can look at those steps, or look at something. There's something that we can go ahead and do. So as we go forth, I just ask, let's bow our heads. Gracious God, we thank you, Lord, for these lives that we have, Lord, that you have instilled your breath of life within us. We thank you for the skills that you have given us, Lord, that we are lucky enough to live within a nation where we are compensated for the work that we do. And so, Lord, as we have these gifts, help us to be good stewards of what you have given to us, Lord, so that we can do more through what we have, through ourselves, Lord, through the money that we have, and Lord, just through everything else, that your will might be done in this world. Lord, as we go forth, watch over us. Keep us safe on our travels home. Be with all those who couldn't be with us tonight, Lord, and